Before we begin, it's crucial to understand that the information provided in this video is for educational and informational purposes only. It is not intended to be, and should not be taken as legal, financial, or insurance advice. We are not attorneys, licensed insurance agents, or financial advisors. The world of insurance is complex and state-specific. You should always consult with a qualified and licensed professional in your state to discuss your individual circumstances and needs. Imagine this for a second. You're driving down the 5, maybe heading home from work, stuck in that classic Southern California traffic. You're doing everything right. You're focused, hands at 10 and 2. Suddenly, a jolt. The car behind you, the one that's been tailgating you for the last 2 miles, finally makes a mistake and slams into your bumper. It's not a huge crash, but it's enough to send a shockwave through your body and crumple your rear end. You pull over. The other driver is apologetic. You exchange information, take pictures, and you think, okay, this is a pain, but that's what insurance is for. But a week later, you get a call from your insurance company. The other driver's policy? It was a fake. Or maybe it lapsed last month because they didn't pay the bill. Or worst of all, they only have the bare minimum coverage required by the state. And that's when the real nightmare begins. Because now, you're on the hook. Your car repairs, your medical bills, your rental car. It all falls on you, and the policy you thought was protecting you might not be enough. This scenario isn't just a scary story. It happens thousands of times a day across the Golden State. And it reveals a terrifying truth. Most of us are driving around with a ticking financial time bomb in our glove compartment, and we don't even know it. We think our auto insurance policy is a shield, but for millions of Californians, it's more like a piece of paper with holes in it. We pay our premiums every month, trusting that we're covered. But do you really know what you're paying for? Do you know what those numbers on your declaration page actually mean in a real-world accident? If the answer is no, you are not alone. The insurance industry is designed to be confusing. But by the end of this presentation, that confusion ends. We are going to pull back the curtain on California auto insurance. We're going to arm you with the knowledge you need to protect yourself, your family, and your financial future from the single biggest threat you face every time you get behind the wheel. So let's start with the biggest lie in the entire auto insurance industry: the state minimum. You see them advertised everywhere. Get insured for just $1 a day. California's cheapest legal coverage. And it sounds great, right? You're a safe driver, you've never had an accident. Why pay more than you absolutely have to? Here's why. Because the state minimum in California is a trap. It is designed to make you legally compliant, not financially safe. It checks a box for the DMV, but it will abandon you the second you actually need it. In California, the minimum liability coverage you're required to carry is what's called 15/30/5. Let's break down what that pathetic number actually means. The first number, 15, stands for $15,000. That is the maximum amount your insurance company will pay for bodily injury to a single person that you injure in an accident you cause. One person, $15,000. Think about that. Have you seen the cost of an ambulance ride lately? A trip to the emergency room? A single MRI? $15,000 can be vaporized before the injured person is even discharged from the hospital. If their medical bills are $25,000 or $50,000 or more, and they easily can be, guess who's personally on the hook for the difference? You are. The second number, 30, stands for $30,000. That's the maximum your policy will pay for bodily injury for the entire accident, no matter how many people you injure. So if you cause a fender bender and there are 3 people in the other car, and they all have minor whiplash and need some chiropractic care, your policy has a total of $30,000 to split between all of them. If one person's injuries hit $15,000, there's only $15,000 left for everyone else. If their combined medical bills hit $60,000, your insurance pays the first $30,000, and the other $30,000? That becomes your personal debt. They can and will come after you for it. And the last number, the 5, is almost a joke. It's $5,000. That is the maximum your policy will pay for property damage. This means damage to the other person's car, or a fence you hit, or a light pole. $5,000. What new car on the road today costs less than $5,000? Even a minor bumper repair on a modern car with all its sensors and cameras can easily exceed that amount. If you tap the back of a new Tesla or a BMW in a parking lot, that $5,000 is gone in a flash. And if you total their $40,000 SUV, your insurance company will write a check for $5,000, wish you the best of luck, and walk away. You are now personally responsible for the remaining $35,000. Are you starting to see the trap? The state minimum is not protection. It is a permission slip to drive that offers the illusion of security. It leaves you one minor accident away from having your wages garnished, a lien put on your house, and your life savings wiped out. And here's the kicker. California has one of the highest percentages of uninsured and underinsured drivers in the entire country. The Insurance Research Council estimates that 1 in 7 drivers on the road with you right now has no insurance at all. And of the ones who do, a massive percentage are carrying only these laughably low minimums. This means the odds are incredibly high that if you get hit, the person who hit you won't have enough coverage or any coverage to pay for your damages. So the problem is twofold. First, if you only have the state minimum, you are dangerously exposed if you cause an accident. Your entire financial life is hanging by a thread. Second, even if you are the world's safest driver, you are sharing the road with millions of people who are carrying these ticking time bomb policies. If one of them hits you, you are the one who pays the price. Your state minimum liability policy does absolutely nothing to cover you or your car if you are hit by someone else who is uninsured or underinsured. It only covers the damage you do to others. This is the reality of driving in California. It's not about being a good driver. It's about understanding the financial battlefield you're on every single day. The cheap policy you bought online to save a few bucks could end up being the most expensive decision you ever make. But don't worry. This isn't about scaring you. It's about empowering you. Because there is a way to build an ironclad shield around your assets. There are specific coverages, often for just a few dollars more per month, that can completely transform your policy from a piece of paper into a fortress. And in the next part, we are going to start building that fortress. We will talk about the single most important coverage you can buy in California, the one that directly protects you from that nightmare scenario we opened with. The uninsured and underinsured motorist coverage. This is the secret weapon, and you need to understand exactly how it works. Think of it this way. When you buy liability insurance, you're buying protection for your assets in case you hurt someone else. You're being a responsible citizen. But what about when an irresponsible citizen hurts you? That's where uninsured and underinsured motorist coverage, or UM/UIM, comes in. This isn't insurance for them. This is insurance you buy for yourself and your family. A shield against the 1 in 7 California drivers who are illegally on the road without a single dime of insurance. Let's break that down. 1 in 7. Look around you the next time you're in traffic. For every 7 cars you see, statistically, one of them has no way to pay for the damage they cause. They can't cover your medical bills, your lost wages, your pain and suffering, or even the damage to your car. If they hit you, they might just say sorry and drive away. Or more likely, they'll be slapped with a ticket, have their license suspended, but none of that helps you. You're left holding the bag, a victim of a crime with a mountain of bills piling up. Your health insurance might cover some of the medical costs, but what about the deductibles? The co-pays? The treatments they won't approve? And what about the money you can't earn because you can't work? Health insurance doesn't cover that. That's where uninsured motorist coverage becomes your financial life raft. It's divided into 2 main parts. The first and most important is uninsured motorist bodily injury, or UMBI. If you are hit by a driver who has no insurance at all, or by a hit-and-run driver who is never identified, your own insurance company steps into the shoes of the at-fault driver's non-existent insurance. They will pay for your medical expenses, both past and future. They will pay for your lost income. And critically, they will pay for your pain, suffering, and emotional distress, something your health insurance will never ever touch. Imagine you're in a serious accident. Your leg is broken in 3 places. You need surgery, a hospital stay, and months of physical therapy. Your medical bills climb to $80,000. You're out of work for 4 months, losing $20,000 in wages. The driver who hit you is uninsured. Without UMBI coverage, you are in a catastrophic financial hole. You might have to sue the driver personally, but if they didn't have money for insurance, it's a near certainty they don't have $100,000 sitting around to pay a judgment. You'll likely never see a penny. But if you had a UMBI policy with limits of say 100/300, that's $100,000 per person, $300,000 per accident, your own insurance company would cover your $80,000 in medical bills and your $20,000 in lost wages. They would pay you a total of $100,000. You are made whole. The nightmare is contained. Now let's talk about the silent partner to this coverage, underinsured motorist, or UIM. This is arguably even more insidious because the driver who hits you does have insurance. They're technically legal. The problem is they only bought the California state minimum, that tiny 15/30/5 policy we talked about. $15,000 for bodily injury. In today's world, $15,000 is nothing. A single ambulance ride and an emergency room visit can eat up that entire amount before you're even admitted to the hospital. So let's use our same example. The driver who broke your leg has a 15/30 policy. Your bills are $100,000. Their insurance company will promptly write you a check for their policy limit, $15,000. And that's it. They're done. Their legal obligation is fulfilled. You are still left with $85,000 of debt and lost income. This is where underinsured motorist coverage saves you. Your UIM policy will look at your total damages, $100,000, and see that you only received $15,000 from the other driver. It will then pay you the difference up to your own policy limit. So, if you have that 100/300 UIM policy, it will pay you the remaining $85,000. Again, you are made whole. You are protected from someone else's decision to buy the cheapest, most inadequate insurance possible. This is why the single most important piece of advice I can give you is this. Your uninsured and underinsured motorist coverage limits should always be equal to your own bodily injury liability limits. If you choose to protect other people from your own potential mistakes with a 250/500 policy, you must give yourself and your family that same level of protection from everyone else. Why would you value a stranger's well-being more than your own family's? It's a simple question, but it's the core of why this coverage is so vital. You are essentially setting the standard for the quality of insurance you are willing to be hit by. There's also a property damage component, called uninsured motorist property damage, or UMPD. This is designed to repair your car if you're hit by an uninsured driver. In California, it typically provides up to $3,500 of coverage. Now, here's a critical distinction. This coverage generally only applies if you do not have collision coverage on your policy. Think of it as a last resort for people with older cars who have dropped collision to save money. If you do have collision coverage, that's what you'll use to fix your car. However, having UMPD can sometimes offer a benefit. Some insurance companies will waive your collision deductible if you are hit by an identified, but uninsured, at-fault driver. This saves you from paying that $500 or $1,000 out of pocket. You need to check your specific policy language, but it's a valuable perk. People hear all this and they think, okay, this sounds great, but it must be expensive. And this is the biggest misconception. Adding robust UM/UIM coverage to your policy is one of the most cost-effective things you can do. The peace of mind and the massive financial shield it provides often costs just a few extra dollars a month. We're talking about the price of a couple of fancy coffees for protection that could prevent you from going bankrupt. There is no better return on investment in your entire auto policy. And that brings me to the final, most dangerous trap. In California, your insurance carrier is required by law to offer you UM/UIM coverage in an amount equal to your liability limits. However, you are allowed to reject this coverage. To do so, you have to sign a special waiver, a legal document that explicitly states you are declining this protection. Insurance agents trying to hit a low price point for a customer might present this waiver as a simple way to save $50 on a 6-month premium. They'll slide the form over and say, "Just sign here to get the lower rate." Do not ever sign that form. Signing that waiver is like walking into a casino and putting your entire life savings on a single spin of the roulette wheel. You are betting that you will never be the victim of an uninsured or underinsured driver. With 1 in 7 drivers on the road lacking insurance, those are terrible odds. You are saving pennies to expose yourself to hundreds of thousands of dollars in potential risk. It is the single worst financial decision you can make regarding your auto insurance. Insist on this coverage. Make sure your limits match your liability limits. Check your policy declarations page right now. And if you see that you've waived this coverage, call your agent immediately and have it added. It is the bedrock of a responsible auto insurance policy. Now that you've built this essential shield to protect you from other drivers, there's another layer of protection you need to consider. One that covers your medical bills immediately, regardless of who is at fault. It's called medical payments coverage, or MedPay, and it works in a completely different way than anything we've discussed so far. It's your immediate financial first aid kit. And it is absolutely vital that you understand how this first aid kit works, because it operates on a principle that is the exact opposite of liability insurance. Remember how liability is all about proving fault? It's a slow, deliberate process of investigations, police reports, and arguments between insurance companies to decide who pays for what. That can take weeks, even months. But what if you need medical attention now? What if your passenger twisted their ankle getting out of the car after the impact? What if your kid in the backseat is shaken up and needs to be checked out at an urgent care just to be safe? You can't wait for the insurance companies to finish their debate. You need care immediately. This is where medical payments coverage, or MedPay, becomes your best friend. MedPay is what's known as a no-fault coverage. Let me say that again because it's the most important thing to know about it. No fault. It doesn't care who was texting, who ran the red light, or who made an illegal U-turn. If you are injured in or by a vehicle, it simply pays for your necessary and reasonable medical expenses, up to the limit you selected. It is immediate. It is direct. There is no argument. Think about it. You're an offender bender. The other driver is apologizing, but you also know you might have been going a little too fast. Fault is murky, but your neck is starting to feel stiff. You need to see a doctor. Instead of worrying about how you're going to pay for that visit, or waiting to see if the other driver's insurance will eventually cover it, you use your MedPay. You go to the doctor, you get a diagnosis, you get treatment, and you submit the bill to your own insurance company under your MedPay coverage. They pay it, end of story. The battle over who was at fault can continue for months, but your immediate medical needs are already taken care of. This coverage isn't just for you, the driver. It typically covers all the passengers in your car at the time of the accident. This is huge. If you're driving your friends to a concert or your kids to soccer practice, your MedPay coverage extends to them. It provides that same immediate financial relief for their medical bills, regardless of who caused the crash. It's a powerful way to take care of the people in your vehicle without getting into a complicated and potentially friendship-ending debate about who is going to foot the bill for their emergency room visit. So what exactly does it cover? The list is broader than you might think. We're talking about health insurance copays and deductibles. We're talking about ambulance fees, hospital visits, x-rays, and lab tests. It can cover chiropractic services, physical therapy, and even necessary dental work if a tooth gets chipped or knocked out in the collision. It's designed to cover that first wave of medical expenses that pop up right after an accident. Now I know what you're thinking. I have great health insurance. Why would I need to pay extra for MedPay? This is probably the #1 question people ask, and it's a fair one. But the answer reveals why MedPay is such a uniquely valuable tool. First, think about your health insurance deductible. The average deductible for an individual health plan in the US can be thousands of dollars. If you get into an accident in February, you likely haven't met that deductible yet. That means you're paying for everything out of pocket, up to that high limit before your health insurance kicks in a single dollar. MedPay can pay that deductible for you. It acts as a bridge, covering those initial costs, so you don't have to drain your savings account just to get the care you need. Second, think about copays and coinsurance. Even after you meet your deductible, your health plan might only cover 80% of the costs, leaving you with the other 20%. An ambulance ride and an emergency room visit can easily cost thousands. 20% of that is still a significant amount of money. MedPay can step in to cover those copays and percentages that your health insurance leaves behind. And third, and this is a big one, health insurance doesn't always cover all the services you might need after a car accident. Many health plans have strict limits on things like chiropractic care, acupuncture, or physical therapy. They might deem it not medically necessary beyond a certain point, even if you're still in pain. MedPay, on the other hand, is specifically designed for accident-related injuries and is often much more flexible in covering these types of restorative treatments. But here is the secret superpower of MedPay that most people, even some insurance agents, don't fully appreciate. Follows you. It's not just about when you're in your car. Let's say you're a pedestrian, legally crossing the street in a crosswalk, and a car hits you. Or you're out for a bike ride and you're struck by a vehicle. Your MedPay coverage from your auto insurance policy can often be used to pay for your medical bills in those situations. It protects you not just as a driver, but as a person moving through a world full of cars. That is an incredible layer of protection that many people are paying for and don't even realize they have. In California, MedPay is optional. You are not required by law to purchase it. This is precisely why it's so important to understand it. Because it's optional, it's often the first thing people decline to save a few dollars a month on their premium. MedPay is typically sold in set amounts. You might see options for $1,000, $2,000, $5,000, $10,000, or even $25,000 in coverage. And the cost to add it is often surprisingly low. For the price of a couple of fancy coffees a month, you can add a $5,000 safety net to your policy. A safety net that makes sure a car accident doesn't immediately become a personal financial crisis. When you weigh that small monthly cost against a potential $5,000 emergency room bill, the value becomes crystal clear. It removes the financial hesitation from seeking medical care. After an accident, your only focus should be on your health and well-being, not on how you're going to afford the bill. MedPay ensures that. It's peace of mind, pure and simple. So we've established that your liability coverage pays for the other person when you're at fault. And we've established that MedPay covers the immediate medical bills for you and your passengers, no matter who is at fault. It's your emergency medical fund, ready to go at a moment's notice. But this brings up a terrifying question. What if the person who smashes into you has no insurance at all? Or what if they only have that bare minimum, state-required $15,000 liability policy, and your medical bills are $50,000? Or $100,000? MedPay is a fantastic first aid kit, but a $5,000 MedPay limit is like bringing a Band-Aid to a sword fight when you're facing catastrophic injuries. When the other driver is irresponsible, when they break the law by driving uninsured, or they are so underinsured that their policy is practically useless against your real-world costs, you are left dangerously exposed. Your entire financial future could be wiped out by someone else's mistake and lack of preparation. This is where the most important coverage you can possibly buy comes into play. It's a type of coverage that acts as a shield, protecting you from the financial fallout caused by millions of uninsured or underinsured drivers on the road. It's your personal financial bodyguard, and it's what we need to break down next. So let's talk about this bodyguard. It's officially known as uninsured and underinsured motorist coverage, or UM/UIM for short. And it's not one thing but a suite of protections. The most critical component is uninsured motorist bodily injury, or UMBI. This is what pays for your medical bills, your lost wages, and even your pain and suffering if you are hit by a driver who has zero insurance. Its partner is underinsured motorist bodily injury, UMBI. This kicks in when the at-fault driver has insurance, but their policy limits are too low to cover the full extent of your injuries. They have a policy, it's just not enough. Together, they form a financial fortress around you and your passengers. And here's why that fortress is absolutely non-negotiable in California. Imagine a guy named David. David is a responsible person. He's a graphic designer, works hard, pays his bills on time. He drives a reliable 5-year-old sedan. When he bought his car insurance, he did what he thought was smart. He got the legally required liability coverage, 15/30/5. And to save about $20 a month, he checked the box to decline uninsured motorist coverage. He thought, I'm a safe driver. I won't cause an accident. Why pay for extra coverage for someone else's mistake? It's a logic that feels sound but is catastrophically flawed. One Tuesday afternoon, David is driving home, waiting to make a left turn at a busy intersection. The light turns yellow, then red. The oncoming car, a beat-up old truck, doesn't even slow down. It plows through the red light and smashes directly into David's driver's side door. The impact is violent. David's world goes black. He wakes up in the hospital. He has a shattered femur, 3 broken ribs, and a severe concussion. The driver of the truck who hit him? He walked away with a few scratches. And when the police report comes back, David's stomach drops. The other driver had no license, no registration, and you guessed it, absolutely no insurance. He's what's known in the legal world as judgment-proof. You can sue him and you might even win, but you can't get blood from a stone. He has no assets, no savings, no way to pay for the damage he caused. So David is on his own. His car is totaled. That's the first blow. But the real nightmare is just beginning. The hospital stay, the surgery to put a titanium rod in his leg, the weeks of follow-up appointments and grueling physical therapy, the medical bills start arriving. First a trickle, then a flood. They cover his kitchen table. The grand total? $85,000. His own health insurance helps, but he has a $7,000 deductible and 20% copays after that. He's on the hook for over $22,000 in medical debt, right out of the gate. But it gets worse. As a graphic designer, he can't work from a hospital bed. He can't focus with a concussion. He's out of work for 4 months. That's over $25,000 in lost income, gone forever. His emergency savings are wiped out in the first month just covering his mortgage. Now he's borrowing from his parents. The stress is immense. His recovery is slower because of the constant anxiety about money. All of this because he tried to save $20 a month. He followed the law, but the law didn't protect him from the financial ruin caused by an irresponsible driver. Now let's rewind. Let's run the exact same scenario, but with one crucial difference. In this alternate reality, when David was buying his insurance, he spent the extra $20 a month. He didn't sign the waiver. He purchased uninsured motorist coverage with limits of $100/300. That means his policy provides up to $100,000 per person and $300,000 per accident for injuries caused by an uninsured driver. The accident happens exactly the same way. The same truck, the same red light runner, the same devastating injuries. The other driver is still uninsured and has no money. But this time, the story has a completely different ending. David calls his own insurance company. He tells them what happened, and his uninsured motorist bodily injury coverage springs into action. His own insurance company effectively steps into the shoes of the at-fault driver's non-existent insurer. They cover his medical bills, all $85,000 of them. They cover his lost wages, that $25,000 he couldn't earn while recovering. His policy pays it. They even provide compensation for his pain and suffering, for the months of agony, the stress, the permanent limp he might have. Instead of facing bankruptcy and a future crippled by debt, David can focus on one thing: his recovery. The fortress held. That $20 a month wasn't an expense. It was the single best investment he ever made. That's the power of uninsured motorist coverage. But what about its twin, underinsured motorist coverage? This handles an even more common and insidious scenario. Let's imagine a different driver, Sarah. She's a nurse, a single mom. She gets hit by a driver who does have insurance. The other driver is at fault, admits it, and provides their insurance information. Sarah feels a wave of relief. At least they're insured. The problem is they have a bare minimum state-mandated 15/30/5 policy. Sarah's injuries are serious. A herniated disc in her back that requires surgery. Her total medical costs and lost wages come to $60,000. The at-fault driver's insurance company is cooperative. They quickly acknowledge their client's fault and agree to pay, but only up to their policy limit. They write Sarah a check for $15,000. That's it. That's all they are legally obligated to pay. Sarah is now left with a $45,000 gap. $45,000 in bills that the at-fault insured driver cannot and will not pay for. This is where millions of Californians find themselves, the victim of an accident, with a responsible party who simply didn't have enough coverage to make things right. But like our wise version of David, Sarah had the foresight to protect herself. She had purchased underinsured motorist bodily injury coverage with $100/300 limits. Her own insurance company now steps in. They look at her total damages, $60,000. They see that the other driver's insurance paid $15,000. So they cover the remaining $45,000 gap. Once again, financial disaster is averted. Her own policy bridged the gap between her actual damages and what the low-limit driver could pay. This is why, when you choose your own policy limits, you're not just deciding how much you'll pay if you hurt someone else. You are setting the ceiling for how much your own insurance company can pay you if you're hurt by an uninsured or underinsured driver. Your UM/UIM limits cannot be higher than your own liability limits. So if you choose low liability limits for yourself, you are forcing yourself to have low protection from the vast majority of other drivers. Now there's one more piece to this puzzle: your car. What happens when an uninsured driver totals your vehicle? This is where uninsured motorist property damage, or UMPD, comes in. In California, this coverage will pay up to a maximum of $3,500 to repair or replace your car if you're hit by a confirmed uninsured driver. Here's the catch: that limit is incredibly low. If your car is worth more than that, you're out of luck. Also, you cannot use this coverage if you also have collision coverage on your policy. And frankly, collision coverage is the far superior option. While it comes with a deductible, say $500 or $1,000, it covers damage to your car regardless of who is at fault. It covers you if an uninsured driver hits you, if a hit-and-run driver vanishes, or even if you accidentally back into a pole. The $3,500 UMPD limit is a tiny band-aid for a potentially catastrophic wound. Relying on collision coverage is like having a full trauma surgeon on call. The most important takeaway here is that your insurance company is legally required to offer you UM/UIM coverage in California. You have to physically sign a document, a waiver, to reject it. They make you take an active step to turn it down. And that piece of paper is one of the most dangerous things you can sign. Rejecting this coverage to save a few dollars is like removing the airbags from your car to save a little weight. You won't notice the difference until the moment you need it most, and by then it's tragically too late. You've protected everyone else on the road from your mistakes, but you've left yourself and your family completely exposed to theirs. So we've built a fortress to protect you from the mistakes of others. But what happens when the mistake is your own? What happens when you slide on a patch of black ice and hit a tree? Or you misjudge a parking spot and scrape a pillar? Your liability coverage won't help you. Your UM/UIM coverage is irrelevant. This is where you need protection for the single most expensive piece of equipment you probably own: your car itself. And that protection comes in two forms that are often confused, but are critically different: collision and comprehensive. Understanding how they work is the key to safeguarding your investment. Let's break them down with a simple analogy. Think of collision coverage as your shield in a battle. Protects you when you actively hit something or something hits you. Comprehensive coverage, on the other hand, is like your fortress. It protects your car from all the chaos that happens around the battle, the random, unpredictable events of the world. Let's start with the shield: collision coverage. This is probably what most people think of when they imagine car insurance. It pays to repair or replace your car after it's damaged in a collision with another object. That object could be another car, a telephone pole, a guardrail, a garage door you forgot was closed. You name it. If you collide with it, this is the coverage that steps in for you. And here is the most important part, the detail that saves people from financial ruin. Collision coverage protects you regardless of who is at fault. Let me repeat that. It doesn't matter if you caused the accident or if the other driver did. If your car is damaged in a wreck, this is your protection. Imagine this scenario. You're leaving a crowded Trader Joe's parking lot in Pasadena. You're trying to back out, you check your mirrors, you check your camera, but at the last second you misjudge the distance to one of those thick concrete pillars. Crunch. It's a sickening sound. Your rear bumper is caved in. A taillight is shattered. There's no one else involved. No one to blame but yourself. Your liability insurance? It has nothing for you here. It's designed to pay for damage you do to others. Without collision coverage, that repair bill, which could easily be $2,000, $3,000, or even $4,000, is coming directly out of your bank account. With collision, you're covered. Now, it's not a completely free ride. This is where your deductible comes into play. A deductible is the amount of money you agree to pay out of pocket for a claim before your insurance company starts paying. Think of it as your share of the cost. The most common deductibles are $500 or $1,000. So, in our Trader Joe's example, if the repair bill is $3,000 and you have a $500 deductible, you pay the first $500, and your insurance company pays the remaining $2,500. Choosing your deductible is a strategic financial decision. A lower deductible, like $250 or $500, means you'll pay less out of pocket if you have an accident. But it also means your monthly insurance premium will be higher. A higher deductible, like $1,000 or $2,000, will lower your monthly premium. But you need to be prepared to pay that higher amount if something happens. It's a classic trade-off between short-term savings and long-term risk. So now for the fortress: comprehensive coverage. Its full name is actually Comprehensive Physical Damage Coverage, which is a mouthful, but it hints at what it does. It covers damage to your car from just about everything except a collision. This is your protection against theft, vandalism, fire, natural disasters like floods or earthquakes, falling objects like a tree branch, and a very common one, hitting an animal. Let's say you live in a quiet suburb in Orange County. You wake up one morning, coffee in hand, and look out the window to see an empty space where your brand new SUV used to be. It's been stolen. Your heart sinks. That's a $50,000 asset that has vanished overnight. Liability won't help. Collision won't help. Only comprehensive coverage will. After you file a police report in your claim, your insurance company will pay you the value of your stolen vehicle, minus your deductible. Or imagine you're driving home late at night through a more rural part of California, maybe near the foothills of the Sierra Nevada. A deer suddenly leaps into the road. There's no time to react. You hit it. This is a terrifying and surprisingly common event. Even though you technically collided with something, insurance companies don't classify hitting an animal as a collision. It falls under comprehensive. Why? Because it's considered an unpredictable, unavoidable event, more like an act of God than a driving error. Without comprehensive, the thousands of dollars in front-end damage would be all on you. So, here's the simplest way to remember the difference. Collision is for crashing. Comprehensive is for chaos. Crashing into things or things crashing into you is collision. The random chaos of the world. Theft, fire, floods, hail, a rock cracking your windshield on the freeway. That's comprehensive. Now, for many drivers in California, the decision to get these coverages is already made for them. If you have a loan on your car or if you're leasing it, your lender or leasing company will almost certainly require you to carry both collision and comprehensive coverage, often with a maximum deductible amount. Why? Because until you pay off that loan, the car isn't technically 100% yours. It's the bank's collateral. They have a financial stake in it. If you total the car and don't have the insurance to repair or replace it, they lose their investment. So they mandate these coverages to protect their asset. The moment you pay off your car and get that title in your name, you have the freedom to decide whether to keep them or drop them. And that's the million-dollar question for anyone who owns their car outright. Should you pay for collision and comprehensive? The answer comes down to a simple, honest financial calculation. You need to weigh the cost of the coverage against the value of your car and your ability to replace it. The first step is to figure out your car's actual cash value, or ACV. This is not what you paid for it. It's what it's worth today, factoring in depreciation, mileage, and condition. You can get a good estimate from sites like Kelley Blue Book or Edmunds. Let's say you have a 12-year-old sedan. Its ACV is about $4,000. Now, look at your insurance policy. How much are you paying per year specifically for collision and comprehensive? Let's say it's $600 a year, and your deductible is $1,000. Here's the math you need to do. If you get into a major accident and your car is totaled, the absolute maximum your insurance company will pay you is the ACV minus your deductible. In this case, that's $4,000 minus your $1,000 deductible, which equals $3,000. So, you're paying $600 a year to protect a potential $3,000 payout. At this point, you have to ask yourself a tough question. Can I afford to lose $4,000? If your car was suddenly gone tomorrow, could you come up with the cash to buy another one without putting yourself in a financial hole? If the answer is no, then paying that $600 a year might be a very wise investment in your peace of mind. But if your car is only worth, say, $1,500, and your deductible is $1,000, the maximum payout is only $500. Is it worth paying hundreds of dollars a year in premiums for a potential $500 check? For most people, the answer is no. At that point, you're better off self-insuring, dropping the coverages, saving that premium money, and putting it into an emergency fund for a new car. A common rule of thumb is if the annual cost of your collision and comprehensive coverage is more than 10% of your car's cash value, it's time to seriously consider dropping it. In California, these coverages are especially relevant. The risk of wildfires charring your car to a crisp is a real threat covered by comprehensive. Catalytic converter theft is rampant in many cities. That's also comprehensive. And with some of the most congested freeways in the nation, from the 405 in LA to the Bay Bridge, the risk of a fender bender or a major pileup makes collision coverage a vital shield for your daily commute. So you've protected your car against crashes and chaos. You're a responsible driver with a solid policy. But what happens when the person who hits you has no insurance at all? You're following the law, but they aren't. In California, that's a terrifyingly common problem. And your financial future could depend on the two little understood coverages we're about to break down next. These two coverages are uninsured motorist bodily injury and underinsured motorist bodily injury. And I'm not exaggerating when I say that understanding them, and more importantly, having them on your policy, can be the only thing standing between you and complete financial devastation. Let's paint a picture. You're driving home on the 405. Traffic is its usual delightful self. Suddenly, you hear the screech of tires and a bone-jarring crunch from behind. You've been rear-ended. Hard. Your head snaps back, your heart is pounding, but you seem to be okay. You pull over to the shoulder, the other driver does too. You get out, your hands are shaking. Your bumper is now somewhere in your trunk. The other driver gets out. They're apologetic, but then they drop the bomb. The 4 words that can turn a bad day into a life-altering nightmare. I don't have insurance. What happens now? The person who caused this, the person who is legally and financially responsible for your medical bills, your lost wages, and the repairs to your car, has nothing. They can't pay. Suing them is like trying to squeeze water from a stone. They have no assets, no insurance company to go after. You are left holding the bag. This isn't some rare freak occurrence. The Insurance Research Council estimates that 1 in 7 drivers in California is uninsured. 1 in 7. Think about the next 7 cars that pass you. Statistically, one of them is a financial time bomb waiting to go off. This is where uninsured motorist bodily injury, or UMBI, becomes your personal financial superhero. UMBI is coverage you buy on your own policy to protect you and your passengers when you are hit by a driver who has no liability insurance at all. It steps into the shoes of the at-fault driver's insurance that should have existed. It covers your medical expenses, from the ambulance ride and the emergency room visit to physical therapy and future surgeries. It covers the wages you lose because you can't work while you're recovering. And critically, it also covers non-economic damages, what's commonly known as pain and suffering. This is a massive distinction. Your personal health insurance might cover your hospital bills, but it's not going to write you a check for the chronic back pain you now have, or the trauma of the accident itself. UMBI can. Now, here's the trap that ensnares so many well-meaning drivers. In California, your insurance company is required to offer you UMBI coverage in amounts equal to your liability limits. So if you have 100/300/50 in liability, they have to offer you 100/300 in UMBI. But many people, trying to save a few dollars a month, either select the state minimum of 15/30ths for their UMBI, or worse, they reject the coverage entirely. Let's be brutally honest. Choosing 15/30ths for your own protection is insane. You're essentially saying, I believe that the absolute maximum value of my health, my ability to work, and my well-being after a serious accident is only $15,000. That's the same ridiculously low amount of coverage that the state forces you to carry for others. Why would you give yourself the same inadequate protection that a high-risk, irresponsible driver is forced to carry? A single night in a California hospital can cost more than $15,000. That doesn't even begin to touch lost wages or long-term care. You need to protect yourself with the same high limits you use to protect others. If you have 100/300 in liability, you should have 100/300 in UMBI. No exceptions. But what about the second, more subtle danger? This is the underinsured driver. They followed the law. They have insurance. But they only have the California state minimum of 15/30ths. Let's go back to our crash scenario. This time, the driver who rear-ended you proudly hands you their proof of insurance. You breathe a sigh of relief. But your injuries are serious. You need surgery on your spine. Your total medical bills climb to $85,000, and you're out of work for 3 months, losing another $15,000 in income. Your total damages are $100,000. You file a claim against the at-fault driver's insurance. Their adjuster is very polite, and they promptly cut you a check for $15,000. That's it. That's their policy limit. They have fulfilled their legal obligation. They wish you the best of luck with the remaining $85,000 you now owe. You are now personally on the hook for $85 grand. This is where underinsured motorist bodily injury, or UIM, swoops in to save the day. UIM is almost always bundled with UMBI. It protects you when the at-fault driver has insurance, but their liability limits are too low to cover your damages. Here's how it works, and the math is critical. Let's say you were smart and you have UIM coverage with limits of 100/300. Your total damages were $100,000. The other driver's insurance paid you their limit of $15,000. Your underinsured motorist coverage will then pay the difference, up to your policy limit. So, it would pay you the remaining $85,000. You would be made whole. Your own insurance policy protected you from the irresponsibility of someone else. Without that UIM coverage, that $85,000 would come from your savings, your retirement fund, or a bankruptcy filing. Having high UIM limits is not a luxury. It's a necessity in a state where millions of drivers are carrying the bare minimum coverage required by law. So we've covered your body. But what about your car? The uninsured driver didn't just hurt you. They totaled your 4,000-pound machine of metal and glass. This is where a related coverage comes in. Uninsured motorist property damage, or UMPD. This coverage will pay to repair your car if you're hit by a confirmed and identified uninsured driver. But, and this is a huge but, UMPD in California is capped at a measly $3,500. That might cover a bumper on an old Honda, but on a modern car with sensors and cameras, $3,500 is often just a down payment on the repair bill. Furthermore, UMPD only applies if the uninsured driver is identified. If it's a hit and run, UMPD won't help you. For this reason, I and most insurance professionals view UMPD as a weak, last resort coverage. The far better way to protect your vehicle is with collision coverage. We'll do a deep dive on collision and comprehensive later, but the short version is this. Collision coverage pays to repair or replace your car if it's damaged in an accident, regardless of who is at fault. It doesn't matter if the other driver was uninsured, underinsured, or a ghost. Your car is covered, minus your deductible. If you have a car loan or a lease, it's required anyway. If you own your car outright and it's worth more than a few $1,000s, you should have collision coverage, which makes UMPD completely redundant. You can't use both for the same claim. It's one or the other. Choose collision. Now, the most terrifying part. As I mentioned, insurance companies must offer you UMBI and UIM, but the law also gives you the ability to reject it. To save maybe $10 or $20 a month, you can sign a form, a legal waiver that says, "I understand the risks and I decline this protection." Signing that waiver is, without a doubt, one of the single most dangerous financial decisions a person can make. You are betting your entire financial future, your health, and your family's stability on the hope that you will never, ever be seriously injured by one of the millions of uninsured or underinsured drivers roaming the roads of California. It is a gamble with catastrophic consequences. The cost of this coverage is minuscule compared to the protection it provides. Do not reject it, ever. So let's recap. Your liability coverage protects everyone else when you cause an accident. Your uninsured and underinsured motorist coverage protects you and your family when someone else causes an accident and they can't pay for the damage they've done. You've built a fortress around your assets and your health, but there's still a massive hole in your defense. What happens if the accident is your fault? Your liability pays for the other driver's injuries. But who pays for yours? Who covers your ambulance ride, your hospital stay, your lost wages when you are the one to blame? That's where our next piece of the puzzle comes in. A surprisingly affordable coverage that many people overlook, called medical payments coverage, or as it's often called, MedPay. Now, this is one of the most misunderstood and underappreciated coverages on the entire policy, but it might just be the most important one for your own personal financial well-being, especially in that split second after an accident. Let's imagine a scenario. You're driving home after a long day at work. You're stopped in traffic, you glance down at your phone for just a second to check a notification, and when you look up, the car in front of you has slammed on its brakes. You hit yours, but it's too late. It's a low-speed collision, a classic rear-ender. The damage to the cars isn't catastrophic, but your airbag deploys. The jolt gives you a nasty case of whiplash, and your knee smacks hard against the dashboard. The police arrive, they take a report, and it's clear. You are 100% at fault. The other driver's insurance will take care of their car and their medical needs. That's what your liability coverage is for. But what about you? Your neck is screaming in pain, your knee is swelling up, and the paramedics are recommending a trip to the emergency room just to be safe. You agree. They load you onto a gurney. A few weeks later, the bills start arriving. There's a $2,000 bill for the ambulance ride. There's a $5,000 bill from the emergency room for the x-rays, the CT scan, and the doctor's examination. Your primary care physician wants you to do 6 weeks of physical therapy to deal with the whiplash, which is going to cost another $3,000. All told, you're looking at $10,000 in medical expenses. You think, okay, no problem. I have great health insurance through my job. So you pull out your card and you look at the details. And that's when your stomach drops. You have a $5,000 annual deductible. That means you have to pay the first $5,000 of your medical care for the year completely out of your own pocket before your health insurance pays a single dime. So that ambulance bill and a huge chunk of that ER bill, that's all on you. Right now, you have to come up with $5,000 cash just to cover the immediate aftermath of a minor accident that was your fault. For most people, that's a devastating, unexpected expense. It's the kind of thing that wipes out savings accounts or gets thrown onto a high-interest credit card, creating a debt cycle that can last for years. This is the exact gap, the exact nightmare scenario that medical payments coverage is designed to prevent. MedPay is what's known as a no-fault coverage. That's the magic word. No fault. It doesn't care who caused the accident. If you are injured in your car or because of a car, it pays. Period. It covers you, your family members who live with you, and any passengers in your vehicle at the time of the accident. And here's the most critical part. MedPay is typically a primary coverage. This means it pays out before your health insurance. So in our scenario, if you had $10,000 of MedPay coverage, you wouldn't have paid a penny out of pocket. You would simply submit that $2,000 ambulance bill and that $5,000 ER bill directly to your own auto insurance company, and they would pay it up to your coverage limit. Your health insurance deductible remains untouched. You don't have to drain your savings. You don't have to go into debt. The entire financial stress of the situation just evaporates. The coverage is incredibly broad. It covers necessary medical services, surgery, x-rays, dental work if you chipped a tooth on the steering wheel, nursing care, and even funeral expenses in a worst-case scenario. It covers things that health insurance sometimes fights, like chiropractic care or acupuncture for pain management. But here's the secret benefit that almost nobody knows about. MedPay follows you. It's not just for when you're driving your own car. Let's say you're out for a jog and a distracted driver clips you in a crosswalk. Your MedPay can kick in to cover your injuries. What if you're riding your bicycle and someone opens their car door right in front of you? Your MedPay can cover that. What if you're a passenger in your friend's Uber and they get into an accident? Your own MedPay coverage from your own car insurance policy can be used to pay for your medical bills. It is a portable safety net for almost any situation where you are injured by a vehicle. Now, you're probably thinking this sounds expensive. It has to be, right? This is the best part. Shockingly cheap. Adding $5,000 or $10,000 of MedPay coverage to your policy might only cost you a few extra dollars a month. We're talking less than the price of a couple of fancy coffees. When you compare a premium that might be $5 to $10 a month to a single $2,000 ambulance bill, the value is astronomical. It's one of the highest value, lowest cost additions you can make to your policy. Think about it this way. MedPay and health insurance aren't competitors. They're a team. Your health insurance is your heavy hitter, there to protect you from catastrophic, $100,000 medical bills. But MedPay is your frontline defense. It's the goalie that stops the first $5,000 or $10,000 in pucks from ever getting through, saving you from the immediate out-of-pocket pain of your deductible and copays. And let's not forget about your passengers. What if you have friends or family in the car with you during that at-fault accident? They're injured too. Without MedPay, they'd have to rely on their own health insurance, or worse, they might be forced to file a liability claim against you, their friend, their family member, to get their medical bills paid. That's an incredibly awkward and relationship-straining situation. But if you have MedPay, it covers them too. No fault, no blame. It provides for their care, pays their bills, and preserves your relationship. It's peace of mind not just for your finances, but for your personal life. In California, MedPay is not legally required, which is why so many people, in an effort to get the cheapest possible policy, say no when it's offered. They see it as an optional extra. But calling it optional is like calling your airbags optional. You hope you never have to use them, but if you do, you will be eternally grateful you had the foresight to get them. It is the single best way to ensure that in an at-fault accident, you protect your health and your savings from the immediate financial fallout. So we've now covered how to pay for the other person's car, their injuries, and even your own medical bills. We've built a pretty solid fortress of financial protection. But there's one giant glaring hole left in our plan. In that scenario where you rear-ended the other car, who pays to fix your car? Your liability insurance won't. Your MedPay won't. If your car is your daily lifeline, your way to get to work, to get your kids to school, having it out of commission is a crisis. You're on your own to pay for thousands of dollars in repairs, or even worse, to replace the entire vehicle, unless you have the two crucial coverages that deal directly with damage to your own property. And that's exactly where we're going next. These two coverages are called collision and comprehensive. And if you have a car that you can't afford to just throw away and buy a new one tomorrow, you need to understand them intimately, because they are the only things that stand between you and financial disaster when your own car gets wrecked. Let's start with collision coverage. The name is pretty self-explanatory. This covers damage to your vehicle when it collides with another object, be it another car, a guardrail, a telephone pole, or even a pothole that causes you to lose control and hit a curb. It also covers rollovers. The key thing to remember is that collision coverage pays out regardless of who is at fault. Think back to our hit-and-run scenario. The other driver is gone. Their liability insurance is a ghost. Your liability insurance does nothing for your car. But if you have collision coverage, you can file a claim with your own insurance company. You'll pay your deductible, which is the amount you agreed to pay out of pocket before your insurance kicks in, and they will cover the rest of the repair costs, up to the actual cash value of your car. Suddenly, that $5,000 repair bill becomes a much more manageable $500 or $1,000 deductible payment. It's the difference between a major inconvenience and a full-blown financial crisis. And it's not just for hit-and-runs. Let's say you're driving on a rainy night, you misjudge a turn, and you hydroplane into a fence. It's your fault. 100%. Again, your liability coverage is for the fence you damaged, not for your crumpled front end. But your collision coverage? That's for you. It steps in to pay for your repairs minus your deductible, even when you are the one who made the mistake. This is a safety net for human error. We all make mistakes. Collision coverage ensures that a single bad moment on the road doesn't wipe out the value of one of your most expensive assets. So, collision covers you when your car hits something. Simple enough. But what about all the other ways a car can be damaged or lost? What about the things that have nothing to do with a traffic accident? This is where the second hero of our story comes in. Comprehensive coverage. Some people call it other than collision coverage, which is actually a perfect description. Comprehensive protects your car from just about everything else. We're talking theft. If your car gets stolen, comprehensive coverage will pay you its actual cash value, minus your deductible. We're talking vandalism. Someone keys your car or smashes your windows. That's a comprehensive claim. Fire. Covered. Flooding from a storm? Covered. A tree branch falling on your roof during a windstorm? That's comprehensive. Hitting a deer on a country road? Surprisingly, that's also a comprehensive claim, not collision, because animals are considered an act of God, or an unavoidable road hazard in the eyes of insurance. Let's imagine you wake up one morning, ready for work. You walk outside and your car is gone. Just an empty space where you parked it. The police are called, a report is filed, but the odds of getting it back are slim. If you only have liability insurance, you are now without a car, and you're still making payments on a vehicle you don't even own anymore. It's a nightmare. But if you have comprehensive coverage, you file a claim, you pay your deductible, and the insurance company cuts you a check for the value of the car, allowing you to pay off your loan and get a down payment on a new vehicle. Or picture this. A hailstorm rolls through your neighborhood. Your car is parked outside. 10 minutes later, the storm passes and your car's roof and hood look like the surface of a golf ball. It's thousands of dollars in damage. There was no collision. You weren't at fault. But without comprehensive coverage, that repair bill is entirely on you. Together, collision and comprehensive are often referred to as full coverage. This isn't an official insurance term, but it's what people usually mean when they say it. They mean a policy that protects other people through liability, and also protects their own car through collision and comprehensive. Now, a critical question arises: do you need them? California law says you only need liability, but the law isn't the only entity that has a say. If you have a loan on your car or if you're leasing it, the answer is almost certainly yes. In fact, your lender or leasing company will contractually require you to carry both collision and comprehensive coverage, usually with a deductible no higher than $1,000. Why? Because until you pay off that loan, the bank or finance company is the legal owner of that vehicle. It's their asset. It's the collateral that secures your loan. If you wreck that car and you can't afford to fix it, you might just stop making payments. The bank is then left with a worthless piece of metal and a defaulted loan. By forcing you to have collision and comprehensive, they are protecting their investment. They are making sure that no matter what happens, a crash, a fire, a theft, there is money available to either repair the car or pay off the loan balance. But what if your car is paid off? What if you own it free and clear? This is where it becomes a personal financial decision. You're no longer required to have these coverages. So, should you keep them? The standard advice from financial experts is to look at two things: the value of your car and your ability to replace it. A good rule of thumb is the 10% rule. Take the actual cash value of your car, what you could sell it for today, which you can look up on a site like Kelley Blue Book. Now look at how much you're paying per year for your collision and comprehensive premiums combined. If that annual premium is more than 10% of your car's value, it may be time to consider dropping them. For example, if your car is an older sedan worth about $3,000, but you're paying $400 a year for collision and comp, you're paying over 13% of the car's value annually just to insure it against damage. In a little over 7 years, you'd have paid more in premiums than the car is even worth. In that case, it might make more sense to drop the coverage, take that $400 you're saving, and put it into a dedicated savings account for a future car repair or replacement. You are essentially self-insuring. The other, more important factor is your emergency fund. If your $10,000 car was totaled tomorrow, Do you have $10,000 in savings you could comfortably use to buy another one without derailing your life? If the answer is no, then keeping collision and comprehensive coverage even on an older car is probably a wise decision. It's a predictable, manageable monthly expense that protects you from a sudden, unpredictable, and potentially devastating financial hit. It's about risk management. You're paying the insurance company a small regular fee to take a huge, uncertain financial risk off of your shoulders. So while the state of California only cares that you can pay for the damage you cause to others, your lender, and your own financial well-being, cares deeply about what happens to your property. Liability is for them. Collision and comprehensive are for you. They are the coverages that actually fix or replace your car. But even with so-called full coverage, there are still massive gaps. What about your medical bills if you're injured? What if the person who hits you has no insurance at all, or just the bare minimum that doesn't even begin to cover your hospital stay? That's when liability, collision, and comprehensive are not enough. You need protection for your own body, not just your property. And that requires two more essential coverages that far too many drivers in California foolishly ignore. The first is called uninsured and underinsured motorist bodily injury coverage. Let's just call it UM/UIM. This isn't just an add-on. In a state like California, with one of the highest rates of uninsured drivers in the country, this is your financial life raft in a sea of irresponsibility. Think about it. You do everything right. You buy a safe car. You pay for good insurance. You're a careful driver. Then one day you're sitting at a red light and bam, you're rear-ended by someone texting and driving. Your back is injured, your car is a wreck. And the other driver gets out, shrugs and says, "Sorry, I don't have insurance." What happens now? Who pays for your medical bills? Who pays for the months of physical therapy you'll need? Who compensates you for the wages you lose because you can't work? If you don't have uninsured motorist coverage, the answer is terrifyingly simple. You do. You are on your own. You can try to sue the other driver personally, but let's be realistic. If they couldn't afford a basic insurance policy, what are the chances they have $50,000 in assets sitting around for you to collect? It's like trying to get blood from a stone. You'll win a judgment on paper that is utterly worthless in reality. This is where uninsured motorist coverage becomes your hero. It steps in and essentially takes the place of the insurance the other driver should have had. Your own insurance company will pay for your medical expenses, your lost income, and your pain and suffering, up to the limits you selected. You are no longer at the mercy of a stranger's bad decisions. You are taking control of your own protection. But that's only half the story. The underinsured part is arguably even more important, because it's so much more deceptive. Let's replay that accident scenario. This time, the driver who hits you does have insurance. They have the California state minimum, $15,000 for bodily injury per person. You're rushed to the hospital. You need an MRI, a few nights for observation, and follow-up visits with a specialist. The first bill that arrives is for $40,000, and more are coming. The other driver's insurance company will politely write you a check for their policy limit, $15,000. And that's it. They are legally off the hook. They've fulfilled their entire obligation. You are now left with a $25,000 hole, and that's before you've even accounted for your lost wages or the chronic pain you might have to live with for the rest of your life. This is financial ruin, delivered by a system that allows people to drive with coverage that is laughably inadequate for the cost of a modern, even minor injury accident. This is where underinsured motorist coverage saves you. After you've collected the $15,000 from the at-fault driver's policy, your UIM coverage kicks in to cover the rest. If you have a UIM limit of $100,000, your policy can pay the remaining $85,000 of your medical bills, lost wages, and other damages. It bridges the gap between the other driver's pathetic coverage and what you actually need to be made whole again. Let me be crystal clear. Relying on other drivers to carry enough insurance to protect you and your family is one of the biggest gambles you can take. You are betting your entire financial future on a complete stranger. Buying high limits of UM/UIM coverage is how you take that bet off the table. You are insuring yourself against the worst-case scenario, regardless of who hits you. A good rule of thumb is to carry UM/UIM limits that are at least equal to your own liability limits. If you're protecting others with $100,000 in liability, why would you protect yourself and your own family with any less? Now, that brings us to the second essential coverage, medical payments or MedPay. If UM/UIM is the surgeon that performs a life-saving operation after a catastrophic crash, MedPay is the paramedic that shows up immediately to stop the bleeding. It's designed for fast, no questions asked payment of your initial medical bills. MedPay is no-fault coverage. It doesn't matter who caused the accident. If you are injured in, on, or around your car, or even as a pedestrian hit by a car, you can use your MedPay coverage. It typically comes in smaller amounts like $1, $2, $5, or $10,000. And its purpose is to handle the immediate costs. The ambulance ride, the emergency room copay, your health insurance deductible, the dental work needed because you chipped a tooth on the steering wheel. A lot of people ask, why do I need MedPay if I have good health insurance? It's a fair question, but it misses the point of how these coverages work together. First, MedPay is primary for auto accidents. That means it pays before your health insurance ever gets involved. You don't have to worry about meeting a $2,000 health insurance deductible out of pocket after a crash. MedPay covers it. You don't have to deal with copays for your first few physical therapy sessions. MedPay covers it. Second, MedPay can cover things your health insurance won't. Many health plans have exclusions for things like chiropractic care, acupuncture, or certain types of dental work, all of which are common needs after a car accident. MedPay can fill these gaps. But here's the most critical reason. MedPay covers not just you, but every single passenger in your car at the time of the accident. Think about that. You're driving your friends or family home. Your cousin from out of town is in the passenger seat. Your child's friend is in the back. If you get into an accident, your MedPay can be used to pay for their immediate medical needs, regardless of what kind of health insurance they have, or if they have any at all. It provides an immediate, compassionate, and responsible way to take care of the people you are carrying in your vehicle, without getting into complicated arguments about who is at fault or whose health insurance should pay. It's an incredibly valuable and inexpensive piece of goodwill and protection. So let's put the whole puzzle together. Liability protects your assets from others. Collision and comprehensive protect the asset of your car. But uninsured/underinsured motorist and medical payments coverage? They protect you. They protect your body. They protect your health. They protect your ability to earn an income. They create a financial fortress around you and your loved ones that can withstand the financial shockwave of a serious accident, regardless of who is at fault or whether they have insurance. They transform your policy from something that just makes you legal into a true personal safety net. Now you have the 5 core coverages. You understand what they do and why they are non-negotiable. You're equipped with more knowledge than 90% of the drivers on the road. You're ready to build a policy that truly protects you. But here's the scary part. Even with the perfect policy with high limits on every single coverage we've discussed, you can still end up with nothing. Your entire claim can be jeopardized by a few simple mistakes. A few innocent words spoken in the chaotic moments after a crash, or in a recorded statement with an adjuster. Your perfect armor has a weak spot. And in our final part, we will expose that vulnerability and give you the exact playbook for what to do, and more importantly, what never to do in the minutes, hours, and days after an accident. That vulnerability isn't a loophole in your policy. It's not a fine print exclusion. It's the human response to chaos. In the moments after a crash, you are in a state of shock. Adrenaline is surging through your system, masking pain, clouding judgment. You are disoriented, scared, and maybe even angry. And it is in this exact state of compromised thinking that the insurance game truly begins. The other driver's insurance adjuster is not your friend. They are a highly trained professional whose entire job, whose performance reviews and bonuses, depend on one single metric: paying you as little as legally possible. They have a playbook, refined over millions of claims, designed to exploit your post-accident confusion. Today we're handing you their playbook so you can counter every move they make. Let's break this down into 2 phases. Phase 1, the scene of the accident. Phase 2, the aftermath. Phase 1, the scene. Your actions here lay the foundation for your entire claim. Get this wrong and you're building your house on sand. First and above all else, ensure your safety. If your car is in a dangerous spot and you can move it, get it to the shoulder. Turn on your hazard lights. Before you do anything else, call 911. I don't care if it's a tiny fender bender with no visible damage. Call them. A police report is an objective, third-party record of the incident. It documents the time, date, location, weather conditions, parties involved, and often contains a preliminary assessment of fault. Without a police report, it can quickly devolve into a he said, she said situation, and the insurance company will always favor their own client's version of events. While you wait for the police, you become an evidence collector. This is not the time to be shy. Use your smartphone. Take pictures of everything. And I mean everything. Get wide shots of the entire scene showing the position of the cars. Get medium shots of the vehicles, showing the points of impact. Get close-up shots of the damage on both cars, from every conceivable angle. Photograph the other driver's license plate. Photograph any debris on the road, any skid marks. Photograph traffic signals, stop signs, and the weather conditions. You cannot take too many photos. Next, exchange information. You need the other driver's full name, address, phone number, driver's license number, and crucially, their insurance company name and policy number. Take a picture of their insurance card and their driver's license. If there are witnesses, get their names and phone numbers immediately. A neutral witness who can corroborate your story is pure gold. Their testimony can shut down any attempt by the other driver to change their story later. Now for the most critical rule at the scene, a rule that feels unnatural but is absolutely essential. Control your words. Do not apologize. Do not say, "I'm so sorry." In our culture, "I'm sorry" is often just a polite expression of sympathy, but to an insurance adjuster, it is a recorded admission of fault. Stick to the facts when speaking to the other driver and the police. The other car ran the red light. I was stopped when I was hit from behind. Factual. Simple. Undeniable. Do not speculate. Do not guess. If you don't know the answer to a question, say, "I don't know." And when someone, the other driver, a paramedic, a police officer, asks you, "Are you okay?" your answer is never ever, "Yes, I'm fine." Adrenaline is a powerful painkiller. You could have a serious soft tissue injury like whiplash, a concussion, or internal bruising that won't become apparent for hours or even days. The correct and only answer is, "I'm not sure. I'll need to be seen by a doctor." Saying "I'm fine" at the scene will be recorded in the police report and used by the adjuster to argue that any injuries you claim later must have happened somewhere else. Phase 2, the aftermath. You've made it home. The adrenaline is wearing off. The aches are starting to set in. Now the phone rings. It's the other driver's insurance company. This is where the real battle is fought, and it's a psychological one. Here is your cardinal rule. Under no circumstances do you give a recorded statement to the other party's insurance adjuster without first consulting with an attorney. They will be incredibly friendly. They will say they just want to get your side of the story to speed up the process. This is a trap. It is the single most effective weapon they have. They are not trying to understand your story. They are trying to build a case against you, using your own words. They are masters of the leading question. They'll ask, "So you were only looking forward right before the impact? You didn't see him coming from the side?" They're trying to establish you weren't paying attention. They'll ask, "How much time passed between you seeing the car and the collision?" They want you to say a split second, so they can argue you didn't have time to react. They'll ask you to describe your injuries, and if you leave something out because you forgot or it wasn't hurting at that exact moment, they will use that omission to deny that injury claim later. The only winning move is not to play. Politely decline to give a recorded statement. Tell them you will have your insurance company or your legal representative contact them. The next trap is the quick settlement offer. Within a day or two, the adjuster might call you up and offer you $500, maybe $1,000, to take care of everything. Seems tempting. You want this to be over. But this offer comes with a price. You have to sign a release of all claims. Once you sign that paper and cash that check, your case is closed. Forever. If 2 weeks later, your doctor tells you that back pain requires an MRI and months of physical therapy costing $10,000, it's too late. You have signed away your rights. Never accept an early settlement offer until you know the full extent of your injuries and property damage. Finally, in the modern age, there's a new minefield: social media. Assume that from the moment the accident is reported, the other insurance company is watching you. They will scour your Facebook, your Instagram, your Twitter. If you filed an injury claim for your back, but you post a picture of yourself lifting a grocery bag, they will use it. If you claim emotional distress but you post a photo smiling with friends at a barbecue, they will use it. They will take your life completely out of context to argue that you are not as injured as you claim. The safest policy is to go completely dark. Do not post anything about the accident. Do not post photos of yourself doing any physical activity. Do not check in anywhere. Stay off social media until your claim is settled. So what do? You've documented the scene. You've refused to give a recorded statement. You've ignored the lowball offer. The next step is to report the claim to your own insurance company. Give them the facts, the photos, the police report number. They are contractually obligated to defend you. But what if your injuries are serious? What if fault is being disputed? What if the adjuster is giving you the runaround? This is the point where you level the playing field. The adjuster is a professional who handles these claims every single day. You are an amateur going through this for maybe the first or second time in your life. You bring in a professional of your own, a reputable personal injury attorney. It's not about being litigious. It's about ensuring you have an expert in your corner who knows the playbook, who knows the true value of your claim, and who can fight back against the insurance company's tactics. Over these 10 parts, we've journeyed through the entire landscape of California auto insurance. From the bare minimum liability coverage to the crucial protections of uninsured motorist and MedPay, we've decoded the jargon, revealed the strategies, and armed you with the knowledge to build your own financial armor. The goal was never to make you an insurance agent, but to make you an informed consumer. Because in the world of insurance, what you don't know absolutely can hurt you. Your policy isn't just a piece of paper the DMV makes you buy. It is the guardian of your financial future. It's the shield that stands between one bad day on the road and a lifetime of debt. Protect it, understand it, and drive safe.